Today on TechEyeSpy, we return to a company that has been a magnet for dreams, debate, speculation, and disappointment in equal measure. Virgin Galactic, a name that once carried the promise of a new era in human spaceflight, and a share price that touched the stratosphere before burning through its own atmosphere on the way back down. It is a company that investors either quietly walk away from or revisit with a sense of unfinished business, trying to understand what went wrong and whether anything meaningful now lies ahead. The third quarter earnings for 2025 have now been released, and buried within the familiar red ink is something different. Not a turnaround, not a rescue, but clarity, clear timelines, clear production milestones, clear financial stress, clear deadlines that the company can no longer drift beyond. For the first time in a while, Virgin Galactic has pinned its future to specific dates and specific pieces of hardware. That alone makes this the right moment to sit down together and look again at what this company is becoming. Because beneath the headlines is a picture of a business that still has a pulse. The production of the first next-generation spaceship is approaching its structural completion. The program is edging closer to the moment where test flights will begin, and the countdown has now been set in stone. The first flight tests are scheduled to begin in the third quarter of 2026. The first commercial spaceflight is expected in the final months of that same year, and the wider ramp of private astronauts is targeting the early seasons of 2027. These are not distant dreams. These are dates that press up against the company's remaining cash runway. Virgin Galactic has approximately 12 months of cash left at its current burn rate. That reality places a very cold clock on everything they do from this moment forward. It is this tension between engineering progress and financial pressure that defines the entire story of Virgin Galactic today. So, in this episode, we will take a fresh and unflinching look at the company using our usual methodical approach. We will explore what has genuinely improved. We will examine what remains deeply fragile. We will look at the opportunities emerging from their gradual march toward commercial readiness. And we will face the threats that could end this story long before a single paying passenger sets foot inside the cabin. This is the 2025 third quarter review of Virgin Galactic. And as always, we are here to study the company, not the myth that surrounds it. Strengths. When we speak about Virgin Galactic today, it is easy to focus on the noise around the share price and forget the underlying engineering effort that has continued even as the market sentiment has collapsed. But if we strip away the emotion and look only at the tangible progress, there are real strengths emerging inside the program. The first of these is the steady maturation of the next-generation spaceship. For years, the company spoke in concept art and broad design principles. Now we are seeing photographed, assembled structures, wings, feather mechanisms, fuselage sections, oxidizer tanks, avionics systems, rocket components. These are no longer theoretical commitments. They are manufactured hard assets sitting inside a factory, moving through a production checklist that genuinely gets shorter every month. In aerospace, this shift from diagrams to hardware is the moment where a program crosses from imagination into reality. The second strength lies in the clarity of the timeline. For a company that has struggled for over a decade with sliding dates and shifting expectations, the decision to lock in a flight test window in the third quarter of 2026, followed by a commercial flight at the end of that year, is a turning point. Timelines are anchors. They force internal discipline. They allow supply chains to commit. They create psychological pressure that focuses both leadership and engineers. And for Virgin Galactic, The presence of these fixed dates is not just welcome, it is necessary. Without this discipline, the program would continue to drift. The third strength is the alignment between production capacity and the target for rapid flight turnaround. Virgin Galactic is building the next generation vehicle with the goal of much shorter refurbishment cycles. This is a critical design choice. The previous generation of spacecraft suffered from limited cadence and high maintenance overhead. The new architecture is being engineered for repeatability. If the company succeeds in achieving even a modest version of this rapid turnaround capability, it transforms the economics of the entire model. One ship that can fly frequently is worth more than 3 that can only fly occasionally. Virgin Galactic has recognized this and has built that principle directly into the new spacecraft. A fourth strength is the slow but deliberate reduction in operating expenses. Research and development spending has decreased as work shifts from design into physical production. Administrative costs have been trimmed. The company is spending less to achieve more, and while it is nowhere near profitability, the direction of travel is the right one. In a field dominated by high burn rates and long lead times, any discipline in spending is a strategic asset. Finally, there is the less obvious but equally important strength of emotional resilience. This company has been through accidents, delays, cash crises, and repeated market downturns. Yet the core team of engineers continues to build. They continue to assemble parts. They continue to move toward a vehicle that may finally fly paying passengers. In aerospace, persistence is not a soft quality. It is a competitive advantage. Many companies collapse under the weight of their own setbacks. Virgin Galactic has not. And that stubborn determination, whatever its flaws, remains one of the company's most enduring strengths. Weaknesses. For all the visible progress inside the factory, Virgin Galactic remains a company defined as much by its limitations as by its ambitions. These weaknesses are structural, persistent, and woven into the very architecture of the business. If we are to understand the company honestly, we must confront these weaknesses without softening the edges. The first and most urgent weakness is the company's financial burn rate. Virgin Galactic continues to consume close to $100 million every quarter. This has been the pattern for years. The latest numbers show a cash reserve that gives the company roughly 12 months of operational life at current spending levels. This creates a stark countdown. Unless revenues appear, or costs fall sharply, or fresh capital is raised, the company will reach the end of its runway before the first commercial flight ever leaves the ground. Very few aerospace programs operate successfully with this level of financial pressure. The second weakness is dilution. To survive, Virgin Galactic repeatedly issues new shares. It is not unusual for companies in frontier sectors to raise funds through equity, but in this case, the dilution has been relentless. Each issuance reduces the value of earlier shareholders and makes long-term recovery far harder. While this keeps the lights on in the short term, it erodes the company's credibility with investors who need to believe that their capital will participate in any future upside. Over time, too much dilution becomes a structural trap, where growth in the underlying business cannot compensate for the expanding share count. A third weakness lies in the company's revenue model. Virgin Galactic reports almost no meaningful revenue. Access fees from future astronauts are symbolic rather than substantive. Until commercial flights begin, the business has no operating income at all. This creates a fragile financial ecosystem where everything depends on a first flight that is still many quarters away. A company with zero revenue cannot absorb shocks. It cannot adapt easily. It cannot withstand a delay. It is at the mercy of every engineering setback and every shift in the market. That vulnerability is a serious weakness. The fourth weakness is the dependency on flawless execution. The timeline is now fixed. Test flights in the third quarter of 2026. Commercial flights at the end of the same year. Any delay, even a small one, pushes the entire program closer to the edge of its cash runway. This is an unforgiving environment. Aerospace programs are rarely on time. Schedules slip. Components arrive late. Test results require redesigns. Weather intervenes. Regulatory reviews expand. Virgin Galactic has no spare capacity in its timeline to absorb such delays without consequence. A fifth weakness is the limited design scope of the current spacecraft. The next generation vehicle is a significant improvement over its predecessor, but it remains a suborbital tourism craft with restricted payload capacity, limited reuse cadence, and heavy ground support requirements. It is not a multi-purpose platform. It is not suitable for cargo. It is not suitable for science missions at scale. And it lacks the flexibility that would allow the company to unlock additional revenue streams outside tourism. In a world where competitors are building architectures capable of transporting crew, cargo, and research payloads, Virgin Galactic stands at the narrow end of the commercial spectrum. And underlying all of these weaknesses is a final point. The company's credibility has been damaged by years of delays and shifting expectations. Investors no longer respond to announcements with optimism. They respond with caution. This erosion of trust makes fundraising more difficult, and in a capital-intensive sector like private spaceflight, trust is a currency as vital as cash. Once lost, it is hard to recover. These weaknesses do not erase Virgin Galactic's progress, but they shape the reality the company must navigate. And any honest analysis has to take them seriously. Opportunities. When a company sits at the edge of risk, the opportunities that remain often become more sharply defined. Virgin Galactic is no exception. Despite the financial strain and the long timeline before meaningful revenue, there are genuine opportunities emerging as the next generation spacecraft approaches the critical test phase. The first opportunity is the arrival of a clear commercial horizon. For the first time, the company can point to a realistic sequence of events. Test flights in the third quarter of 2026. A first commercial spaceflight in the final months of the year. A steady ramp of private astronauts in the early seasons of 2027. Investors respond differently when a company moves from vague ambition to a defined path with dates and milestones. This alone has the potential to rebuild some confidence and attract a new wave of speculative interest as those milestones draw nearer. A second opportunity lies in the visual and structural progress now taking place inside the factory. Aerospace is a world where photographs speak more loudly than promises. Wings attached to fuselage sections, feather mechanisms installed, tanks prepared for qualification. These images signal that the program is shifting from design to completion. In a market often driven by perception and momentum, the steady release of visible progress can act as a catalyst. Each new assembly milestone draws attention, keeps the company in the public eye, and helps maintain the narrative that the program is genuinely moving forward. The third opportunity is the company's capacity to become a thought leader in the premium tourism sector of space. Virgin Galactic's brand is still recognized globally. The aspiration of seeing Earth from above remains powerful. If the company succeeds in conducting a safe and well-presented first commercial flight, it will dominate the headlines far beyond the usual aerospace press. That moment could reset the company's story and shift public attention away from its long history of delays. In a world shaped by social media and spectacle, A single successful flight can generate global visibility and renewed demand. A fourth opportunity emerges from the potential to expand into research and training missions. Suborbital flight offers unique conditions that can support microgravity experiments, biomedical studies, high-altitude fluid research, or early-stage materials science. With the right partnerships, the company could unlock new revenue streams that are not dependent solely on wealthy private passengers. The announced research mission with Purdue University hints at this direction. If cultivated correctly, this segment could become a stabilizing component of the business model, offering repeat customers and institutional contracts that provide more predictable income. A fifth opportunity lies in the company's shift toward faster turnaround times. If the next generation spacecraft can fly more frequently than its predecessor, even at a modest level, the economics of the business improve significantly. Frequency is the key to profitability. A vehicle that flies multiple times a week instead of once every few months transforms the financial picture. This represents a major lever for revenue growth as the fleet expands. And finally, Virgin Galactic benefits from an industry-wide narrative that still believes in the broader future of commercial human spaceflight. Governments, investors, and the public are increasingly comfortable with the idea that space tourism, suborbital research, and high-altitude commercial operations will become normalized. If the company can survive long enough to participate in this shift, it will operate in a market far more mature and far more favorable than the one it struggled against in the past. These opportunities do not guarantee success, but they provide the company with real paths forward. In a sector as unforgiving as private spaceflight, having even a handful of viable opportunities is valuable. Virgin Galactic has more than a few, provided it can reach them in time. Threats. For all the progress captured in the latest update, Virgin Galactic operates under a shadow that never fully lifts. Its threats are not abstract. They are real, measurable, and tied directly to the structure of the company and the fragility of its position. If we are to understand the road ahead, we must look directly at these threats with complete clarity. The first and most immediate threat is the company's cash runway. At its current rate of spending, Virgin Galactic has roughly 12 months of operational life remaining. This means the company must either raise new capital, reduce costs even further, or begin generating revenue long before its scheduled commercial flights in the final months of 2026. None of these options are easy. Capital markets are colder than they once were. Dilution is already heavy, and cost reductions cannot continue indefinitely without slowing the program. This time pressure is unforgiving. It leaves no room for error. The second threat is delay. Aerospace programs rarely move exactly as planned. A component arrives late. A test reveals a vibration issue. A regulator asks for additional data. A supply chain partner suffers its own setback. Each of these events is normal in engineering. But for Virgin Galactic, even a small slip in the timeline could push the first commercial flight beyond the company's financial horizon. Delay is not just inconvenient. It is existential. A third threat comes from competition. Virgin Galactic is no longer operating in an empty field. Blue Origin continues to refine its capabilities. SpaceX has trained the wider public to expect repeatable, disciplined spaceflight. New commercial and state-backed players are emerging across the world. As these companies grow, Virgin Galactic's narrow suborbital tourism model risks becoming a relic of an earlier era, overshadowed by architectures that offer more flexibility, greater altitude, and broader mission profiles. The company must prove that its offering remains relevant in a rapidly advancing industry. A fourth threat lies in the risk of an engineering setback during test flights. Suborbital vehicles operate at the intersection of high-altitude aerodynamics, rocket propulsion, thermal stress, and precision control surfaces. The feather mechanism, the rocket motor, the composite fuselage, the oxidizer tanks, and the avionics must work together with absolute reliability. A single failure, even if survivable, could halt the program for months and remove what little financial runway remains. The safety history of the company is already marked by tragedy. Another incident would be devastating on every level. A fifth threat is regulatory sensitivity. After every high-profile accident in aviation or spaceflight, regulators tend to tighten oversight. Additional reviews, expanded certification requirements, or delays in clearance could slow the company at the very moment it needs to maintain momentum. With no revenue and limited cash, Virgin Galactic cannot afford regulatory friction. And underlying all these threats is the simple fact that the public narrative has shifted. Investors who once viewed Virgin Galactic as a gateway to a new era now see it as a high-risk, low-revenue, heavily diluted stock with a long history of missed timelines. This erosion of confidence makes every future fundraising effort harder. Sentiment becomes a threat in its own right. When confidence fades, capital becomes scarce. These threats form the environment in which Virgin Galactic must now operate. Progress is real, but the risks surrounding the company are large enough to shape its every decision. The path forward is narrow, and survival requires precision, momentum, and an unusual degree of luck. Conclusion. As we reach the end of this review, the shape of Virgin Galactic becomes clearer. This is a company walking a narrow line between real engineering progress and a financial clock that does not stop ticking. The hardware is advancing. The structures are coming together. The program is moving toward a long-promised moment when a new generation of spacecraft will finally take to the skies. But the company's burn rate, its limited cash runway, and the weight of past delays all stand as reminders that the road from progress to profitability is still long and uncertain. Virgin Galactic today is not the dream that captivated early investors. It is something more grounded, more sober, and more constrained. The timelines are defined. The milestones are fixed. The pressure is immense. What happens next will depend on whether the company can move with precision over the next 12 months, and whether it can maintain the trust of investors long enough to reach that first commercial flight. If Virgin Galactic succeeds, it will not erase the missteps of the past, but it will open the door to a future that still contains real potential. If it fails, it will become another lesson in how difficult private spaceflight truly is. Either way, the story is approaching a decisive phase, and for that reason alone, it remains worth studying. Thank you for watching today's episode of TechEyeSpy. If you found this analysis useful, consider subscribing for more deep dives into the companies shaping the future of technology and investment. Your support helps us bring clarity to complex stories, and it is always appreciated.